You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means two things. First off, it is Education Wednesday, time to dive deep into the misty fog and help guide you folks to the shores, the safe shores, through the world of options. And of course, it also means it is the start of Options Bootcamp, what the cool kids call OBC. My name is Mark Longo from theoptionsinsider.com. So, as of course, from the ever scintillating, at least we tend to think so, Options Insider Radio Network, still coming down from the mega high that was I almost said OPR. That's Brian's show later today. OBC 200, the 200th episode spectacular. Thanks to all of you who joined us live or after the fact, who had questions and comments. We love you all out there. Actually, it was kind of a two-part extravaganza because the week before that, we did our first live with an audience Options Bootcamp. Haven't done that in many years. So it was kind of a two-part extravaganza. I hope you folks enjoyed it. I hope you folks checked it out. If you haven't, what are you waiting for? As soon as you're done listening to this, go back into the archives and check out all of that goodness. Of course, if you want to get all those archives, our website and our app are the two best places to get access to everything OBC. No limits, no restrictions. Have at it until your heart's content. And of course, if you want more in your lives, you like that kind of Q&A format we do here, and we did last week live on episode 200. You want more of that? We have special pro Q&As where we welcome on guests from throughout the world of options and derivatives and allow you folks to pick their brains directly with whatever is on top of your noggin. You get to ask it. Those are every Tuesday. And then, of course, Fridays, we have Options Oddities. So you're getting a couple of exclusive extra shows as well as some pretty darn sweet giveaways. I'm looking at the mountain of goods that's going to be lined up for the August Pro Trading Crate. And it's some cool stuff, as well as, of course, live access to this and every other show that we do throughout the week. Theoptionsinsider.com/pro is the place to go to learn more. And joining me on the show, wouldn't it be episode 201? We couldn't embark on the new journey. Many of you said, here's to episode 400. Well, we are embarking on that journey now, all the way to episode 400. It's a long slog. And joining me along the way, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. They say that journey of 1,000 miles begins with one step. This is our first step towards episode 400, sir.
That's right, man. The second part of our journey begins with the first step. Wait a minute. How does that go? But yeah.
Something like that. Something like that. Yes. I think we're in the ballpark there. All right. And, our journey continues whenever you folks leave us nice 5-star reviews on whatever platform you folks are listening to. Last week, we managed to dig up our first ever one. That was fun. From back in 2012, May of 2012, I believe. This week, we have Kay Henderson leaving us a 5-star review saying, learn and earn with OBC. Stop reading this review and start listening now. Well, thank you, Kay Henderson. We're with you. Dan, what do you think? Should we stop reading this review and start listening to the rest of the show, sir? What do you think?
Well, first of all, I love getting those nice, happy, positive reviews. The occasional mean ones. Well, hey, I figure you can learn from any kind of feedback, but especially keep sending in those positive ones. So, hey, I'm good. I'm good either way.
Yeah, it's surprising. This show's been running for over a decade now, as we just established last week. Our average review score is still pretty darn high. So folks like it, Dan. The folks liked it. Every once in a while, you're going to get somebody who doesn't like something. Remember when we dared to question the meme stock palooza last year and people lost their minds? How dare you question the brilliance that is GameStop and AMC and all that kind of stuff? So you never know it's going to trigger people. But for the most part, yeah, for a decade plus, the folks like the show. We like you folks. So let's keep on rolling right on into some basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn.
Just love that. No matter when you're listening to this show, could be in the depths of winter, could be just snow swirling at your doorstep. You're miserable, you're cold. When you hear that, it brings you back to summer, to the 4th of July, to all these celebratory atmosphere that we bring here to the show every week. It's always fun. So welcome to a little bit of the old basic training here. And actually, Dan, our basic training is inspired by a question here from a listener, a very timely and interesting one. This comes from the also interestingly named Mega Tebow. Mega Tebow says, hey, OBC drill instructors, love the show. Well, thank you, Mega Tebow. He also says, congrats on 200 episodes. Well, thank you again. I was listening to the Palooza when I saw this article in the Wall Street Journal. They seem to be pointing the finger at the options market for the recent volatility in the stock market. Maybe you guys can work your magic and explain this for your listeners. Do you guys agree with their conclusion that options are driving volatility and the market? And he sent a link. This is, of course, listeners, if you missed it, a very recent article. Looks like it came out yesterday from Eric Wallerstein in the Wall Street Journal. Now, I used to know and interact with a lot of the journal options folks. I kind of haven't done that much in recent years because it used to be a revolving door. Gunjan held it for a long time over there at the Journal. So it's good to see some stability on the options front. That's one of the reasons why I washed my hands of it. They had a new person covering options almost every year, and it was getting them up to speed on the options market over and over again. It was exhausting. So I kind of just said, you know what, you guys do your thing. So this is Eric Wallerstein. I am not familiar with him. And the article is, the options market is accentuating the swings in stocks. And I'll give you the Cliff's notes here, listen. It's a pretty lengthy article. And then you guys should check it out for yourselves if you want more. The tagline here is, some strategists say reversal in options trading and hedge fund activity are partly to blame for the market's rising volatility. Let's go through some key points here. And they go into the Fed Reserve, spooking investors, blah, blah, blah. But then it says the market summer rally, however, began fizzling a week earlier than the Fed's announcement, coinciding with the August 19th expiration of more than $2 trillion in options. Strategists say that left the market vulnerable to a spike in volatility, one that could feed upon itself if options market dynamics take hold. Then they quote here Jem Carson. He's been on our Volatility View show a number of times, listeners, so you're probably familiar with him. He loves his second-order Greeks. You folks have written in about second-order Greeks. Jem is all about Vanna and Charm. He kind of lives for that stuff. He says, options are primarily an insurance market, but insurance providers do not like to take directional risk. When they sell stock to stay neutral to the market, it can create a circular effect. The days around options expirations are when markets are most vulnerable to macroeconomic events. They can be a tinderbox, he added, that's a nice little quote, nice little gem he threw in, very quotable for the Journal. You know they're going to run with that. So that's one of the key points to take away from this. We'll come back to that, listeners. Expiration is when this effect is strongest. Then they go on to write in the article, since this month's options expiry, the S&P 500 has declined in 5 of 7 sessions, falling 5.8%, and the SIBO VIX has jumped to 26.13 from 19.5. So they're already kind of drawing this weird parallel from options expiration to where we are now a week later. That is somehow linked to the options market, which is a parallel I probably have a little bit of an issue with, but we'll get to more of the article in a second. He says, during the stock market summer rebound, a nearly $1 trillion positive shift in options market flows quelled volatility and buoyed stocks, according to estimates from this person, Charlie McGilligan, managing director of cross-asset macro strategy at Nomura. I do not know him. That helped spur an estimated $110 billion in buying from quantitative hedge funds that follow specific volatility targeting or trend following rules. And they go on to extrapolate even further, which is kind of where the article loses me a little bit. The stuff they're talking about with expiration, the impact on expiration, yeah, I can sink my teeth into that. We can talk about that on the show. That's interesting. That is a demonstrable effect. The rest of this, maybe a little bit less so, but I'm curious to get Dan's thoughts on this too. The S&P rose 17%, they go on to say, between June 17th, the date of June expiry, when 3.4 trillion in options expired, and the corresponding date in August. And they have all these visuals to go along with it. They show the huge rally that occurred that we've talked about many times on the network, listeners, over the last couple of months throughout the summer. And they have these two demarcation points on this graph, listeners, of the beginning of it being June expiration and the end of it being August expiration. And then they pretty much draw this straight parallel line to a conclusion between the 2 points, saying, you know what? These 2 points are the beginning and end of the rally that happened this summer. They also do the same thing with the VIX. They show it, obviously, the VIX is declining because the market is rallying. So they show that options expiration was also the beginning of the end for the VIX here. They go on to do the standard explanation stuff they always do. The standard options are derivatives, that blah, blah, blah. We won't get into that. You're listening to this show. Hopefully you know that by now. They go on to say, importantly, Wall Street banks on the other side of those trades, and this is an interesting part of the article, too. This is another part I think that you should pay attention to. Wall Street banks on the other side of these trades are forced to hedge their positions. We have discussed this before, listeners, on the show. If options dealers are hedging against protection they have sold, that can exacerbate market swings. If dealers are mostly hedging the options bought from investors, then activity will go against the prevailing market trend and dampen volatility. So let's read that again. If options dealers are hedging against protection they have sold, so they're out there selling puts, for example, listeners, and selling options in general, that can exacerbate market swings. Why is that, listeners? Because, hey, they're selling options. They are short gamma. Oh, no. And the reverse is true. If they are buying options from investors, they are long gamma. They have to hedge that long gamma. That's sometimes what can be what keeps us pinned to a strike around certain expirations and things like that. We've discussed that in the past on the show as well. They go on in this article to say options trading has surged in popularity in recent years. We all know that. They go on to say volumes are on track to smash another record this year with more than 40 million contracts changing hands on an average day in 2022. They're making a leap there because we haven't really gotten there yet. It's still an open question whether we're going to beat last year. That's something we've been debating on this network since January 1st of this year. And I don't think we have clear data yet. We're trending in the right direction, but there's still people out there who think we're not going to make it, that if we have another sell-off, that's going to hurt the markets. So it's just the polls we've taken of our audience and of our hosts on the network. It's closer to 50-50 whether we make it or not. I'm going to lean positive. I'm going to be the optimistic guy. In the last couple of years, I faded it, and I've been proven wrong. So I guess this person is making that extrapolation there, Eric, here. And they also say investors are eyeing the monthly jobs report, the next inflation reading due next week, the 13th, as the next catalyst. This is also this person, Brent Kachuba from Spot Gamma. They interview him as well. They don't know him. They have reached out to be on the show in the past, on the network in the past. We haven't set that up, so I have not interacted with him, but he says if we get a positive surprise on inflation or jobs data and the market gets a clearer picture on the path of interest rates, then markets can rapidly bounce higher. But there's nothing in options markets to prevent another tailspin, at least until the September expiry. And then they also throw in a nugget. Rules-based hedge fund strategies are also partially responsible for the summer rally, though that could change as volatility returns. Trend-following strategies have to adjust their exposure based on vol levels, et cetera, et cetera, et cetera. They could return to shorting the market in size if volatility continues picking up. Then they get into this part about CTAs punching above their weight. And then they also go back to their thesis for the article at the end here, saying the boom in activity and options has led many traders to closely track monthly options expiration dates, which they say can stoke greater volatility across markets as dealers positioning rapidly adjust to changing options values and the days leading up to and after that date. Quarterly dates tend to have an even larger impact given the surge in options activity tied to them. You know, they kind of just put out that paragraph. I would have been more on board with what they're putting down here. But intriguing stuff here, Dan. We've kind of debated this in many different formats on the network in the past. This is kind of a variation of, Max Payne and all these other things, which really attribute these very magical powers to options. In this case, options expiration at the end of the day. First off, I'm curious. I know you read the article. What are your overall thoughts on the article? Then we'll get into some of the specifics.
You could just give me the mic for the next 3 hours and
go to town, sir. You got 20 odd minutes. Me, go give you 30.
Okay. So you know what? Listen, I've got this little puppy who's a Morkie who's almost a year old. When is her birthday? Hold on a second here. This is a very important part of this story, by the way. So let's see here. When is her birthday? Oh, it's Sunday. Well, we're going to have to plan a little, party, get some doggy ice cream, get out the silver platter. And when she's a puppy and she's very loving and she just wants to play all day. And when I walk in the house, well, I don't know if you know this, we also have a Yorkshire Terrier. The Yorkie has the tail clipped or docked or whatever they call it, it's just a little nub. But the Morkie has like the full tail. They leave the tail on Morkies, which are half Yorkshire Terrier, half Maltese. So when I come home, she just wants to play so much. Her tail wags like crazy, and she's 4 pounds. Her little tiny butt just wiggles back and forth because her tail is so big that it wiggles her butt, and it's just so funny to watch. But it doesn't wag the whole dog. Okay. And the argument that's being made here in this article is the old classic thing that I've been hearing for 20 years, 30 years. Whenever you hear about options, it's the old tail wags the dog thing. And it's just simply not true. Now, when I say it's not true, things that are completely black or completely white are seldom exist in reality. There are some ways and sometimes when the options market certainly does have an effect on the primary market, the underlying market, but it's a small effect and it's generally temporary. Okay, it's just the little butt wiggling, not the whole darn dog. And so the thing is with this is around expiration. One of the things we see is sort of another fallacy that you brought up, Mark, the Max Payne thing, which is a sillily. Is sillily a word? Kathleen's probably downstairs rolling her eyes right now.
We'll make it a word for you for today, a special Dan word.
Yeah. The sillily named Max Payne theory. What we get around expiration sometimes, more in individual stocks rather than the market as a whole. But we get some pinning that comes from market makers being long options, and on expiration day, especially in the last 10 minutes. If the stock goes above the strike price they're long, they have to sell stock, which pushes it down. And if it goes below the strike price that they're long options in, Gamma makes them short delta, so they have to buy stock, and that forces it back up. So we see a little bit of pinning sometimes. We see a little bit of movement sometimes on things like triple witching, which was not the expiration that was talked about in this article. But on triple witching, we see this happen with a lot of the big things expiring. The SPX technically stops trading the day before, but we see some of the major contracts with some of the very busy quarterly options expiring. So moral of the story is we get a teeny little bit of that on expiration day, but guess what? After expiration, that's all gone. Okay. The liquidity providers that are sort of the unsaid subject of this article, they're going home flat deltas on expiration day, or as flat as they possibly can. And so all their option long deltas are offset by the short stock they already have, and all their option short deltas that they have are offset by all the long stock they already have. And it just goes poof. It just goes gone. and then it resets and it starts over. So to say that an expiration led to higher volatility for a week afterwards, I mean, that just doesn't make any sense. I'm not able to connect those dots. And he did do a good job. The author here did do a good job by selecting some people who, have some pedigree or tenure. I mean, some of these folks are a little bit newer to the market, but have enough experience, right? So he did a good job interviewing them. And, when people are interviewed in the press, they always love to give some sort of sensational thing. What did the one guy say?
It's like a tinderbox gem. Yeah.
Tinderbox.
He threw that out there knowing exactly what he was doing. He wanted to be quoted on that one.
Right.
Gem likes a good quote. Definitely.
Yeah. And so great job with that quote. But, I mean, I wouldn't go as far as saying tinderbox. I would say that it does have some effect, but it's way too much weight is put on it. Now, some of the other things that were alluded to in that article, I would say are unrelated to expiration.
Yeah, that's my biggest problem too, is that they try to conflate these separate things and say this is all part of this, lump them under this whole options umbrella, this whole options rubric, and they're all the same thing when they are demonstrably separate and different things.
Right. And the idea of, and he was saying, the author here, what is this guy's name? Eric was saying, when liquidity, he used a different word than liquidity providers, but, when liquidity providers are taking the other side of hedging orders, that means they're short options. And, there's a lot to, it's not even nitpicking there. It's just simply correcting a misspeak there. I think he's alluding to directional things, not necessarily being long or short options, but being long or short deltas, is what I really think he's trying to allude to there. And so, I mean, there is some truth to the fact that if someone, whether it's a hedger or a speculator, whoever, goes and buys a whole ton of puts, the market makers sell those puts and consequently sell stock short in order to hedge that. And there's nothing nefarious about that or anything. And I don't think it represents any problem that the options market creates. What it does is, like, if you think of when someone shorts a stock, that pushes down that stock. Well, I mean, buying puts is just another way of sort of, voting for the downside. Even if it's a hedge, it's expressing concern for the downside. And so when the market makers sell the puts and then consequently hedge by shorting stock to get delta neutral, I mean, they're just simply reacting to this order flow. They're not creating a situation for the stock to go down. The person who bought those puts creates that situation, and they're creating that situation because they're either fearful of the downside or they think it's going to go down. So I mean, it's just another force that moves the market some, and it moves it a great deal less than the actual fundamental forces at play, than people doing their fundamental analysis and buying or selling shares to represent their vote on the value of the underlying, right? I mean, when it all comes down to it, the way stocks are valued is by fundamentalists analyzing the stocks with a whole bunch of noise thrown on top of it, right? Markets are not strong form efficient by any stretch of the imagination, but they're rooted in that. There is the price discovery process is not a fallacy. It's just a bit convoluted from a lot of noise in the market. And do options create some of that? Sure, and so do traders who are just buying and selling shares. they also create that noise. So I don't know. Yeah, the whole tail wags the dog argument just doesn't fly. It's there's a teeny weeny bit of truth in there, but it's not reality.
Yeah, there's a lot to unpack in this article. I wish they separated it into multiple articles. If they just said, hey, options expiration is a turbulent period, and many factors that we've discussed on this show in the past are present there to an extreme state that they are not present at other times in the expiration cycle, because gamma, as we know, increases exponentially as you get closer to expiration. So it makes sense that the day of expiration, things are wild and crazy when it comes to a gamma perspective. And that's what they're talking about. They don't say gamma because they don't want to terrify you listeners and make you stop reading the article. But that's exactly what they're talking about. They're talking about the impact of gamma. And we've discussed this many times on the show. Strange things can happen on expiration day because things are moving, crazy positions. And gamma can have a catalyst, an exacerbation effect. It was present in some of those extreme upside moves we saw in like GameStop last year and AMC, because those options market makers were caught short gamma to all these upside strikes, to get blowing through all these upside strikes. They had to hedge. That ended up exacerbating the move to the upside. So gamma can play a role in these events around these very specific scenarios, though. The GameStop thing was kind of a bit of an aberration, and expiration itself is a bit of an aberration. But if they just left it there, what's the last paragraph of this article here again? If you just read this, that would be fine. The boom in activity has led many traders to closely track monthly options expiration dates, which they say can stoke greater volatility across markets as dealer positioning rapidly adjust to changing options values. Well, they even say in the days leading up to and after the date. After, I might take issue with. A couple of days leading up to, sure. Okay. So if you just focus on that and that's your takeaway from it, that's fine. When they start drawing these other parallels and they have these graphs to back up their conclusion that clearly options expiration is the catalyst that caused the massive rally over the course of the past summer and the corresponding decrease in volatility, that's when I really start taking a lot of issue with this article. Dan, let's extrapolate. I think we both agree that expiration can be a tumultuous period, and that the article kind of summarizes that nicely. I agree with everything Jem says about expiration there. But about the other part, Dan, the kind of magical inflows of options that have somehow driven the market north over the entirety of the summer, sir.
Yeah, I mean, same, very connected to what I was alluding to before. I mean, it just doesn't really make sense. I mean, is there something to, like, again, this small little bit to, if people were buying calls as the market went up or selling puts as the market went up, and then the market makers, of course, are on the other side of that, getting short delta and having to buy shares of stock. I mean, okay, sure. Is that the liquidity providers doing that? Again, no, they're just hedging to get delta neutral. The force there is the folks buying it. But then, again, I mean, delta on any option is less than 100. In many cases, less than 50. So that trading and the ensuing shares that are purchased or sold, whichever part of this article we're talking about, are smaller and much, much less influential than people actually trading the stock. And a lot of it really does come out in the wash too, because there's people on both sides of the trade. There's people buying calls and there's people selling calls and buying puts and selling puts. And, just to offer any little bit of merit to it, it's just another way of, casting your vote in the price discovery process, where you're effectively, if you're buying calls, you're effectively basically buying shares, or at least causing someone else to do it because you think the stock should be higher. Now that also, I want to mention one more thing about the tail wagging the dog. I recognize that I threw this out there, and some of you are probably saying, Dan, how cute could that 4-pound dog be? So what I did is I posted it on my Instagram, which is Market Taker Mentoring, all one word. And you can see a picture of both of my really cute little dogs.
There you go. The world is sated now. They can see actual photographic evidence of the cuteness of your dogs. You know, while we're talking here, we posted a little quick flash poll here. It's going to go live during the show here and a little bit later throughout the day. So if you listen on the podcast, you might have a chance to get in there. And we just asked you quite simply, the journal claims that the options market was a primary driver for the market rally and the VIX decline over the summer. Do you agree? Gave you three choices, yes, no, or what is gamma? Put that out there. Maybe we'll reveal some early results a little bit later on in the show as we keep on rolling into our mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Even though the whole show's kind of been a mail call, that was a great question. Who asked that question again? Mega Tebow. Mega Tebow. You know, we're not giving away prizes this week, but maybe we need to give a prize. That inspired an entire episode. Dan and I could still talk about that. So great question there, Mega Tebow. Maybe we'll have to send some fabulous prizes your way. Dan, we've been so fired up about all this journal goodness. I'm sure our listeners are going to have some thoughts. We're going to find those out soon. In the meantime, sir, I'm sure you people have been peppering you with questions since the big mastermind and since the big OBC 200, sir. So what is your now 201st question of the week, sir?
Lots and lots and lots of questions. So let's see here. What was a good one that I got this week? Oh, yeah. You know what? I just got one today from one of our folks in our community chat room. And it had to do with our earnings trading system, which is still in force. Earnings season has ended, and so there's just a couple of days here, but we're still trading them. And so when we do our earnings trading time spreads, basically a big part of that is modeling the volatility crushes. And, basically like one of the problems was, hey, the front volatility crushed a little bit, but it didn't hit our modeled targets. And the back volatility crushed much more than the modeled target. And so like a big part of that system is accurately predicting how much volatility will crush. And boy, oh boy, when you talk about the stock market, saying accurately predicted sounds just like a crazy thing to say. And with stock directions, it is a crazy thing to say. I'm just going to tell you that. But with predicting volatility crushes after earnings, man, me and my students who trade this, we get really, really close to it, like crystal ball close. I don't want to toot my own horn too much, but holy moly. But this one was a much trickier one. And boy, I don't really even know how to phrase this in a question. I'm just going to kind of give you the answer without the question. This is sort of like the Hitchhiker's Guide to the Galaxy. The answer is 42, but what's the question? So a lot of times when we're looking at the historical volatility, which is one of the components of this thing, when we're looking at the historical volatility, sometimes when there's one big move in the market, which is just like this one-time event, like we saw a couple of days ago in the market and many, many individual stocks, that causes the implied volatility to raise like a lot. And then when you consider the fact that the historical volatility it's calculated kind of like a moving average where one day comes in and the old day comes out. So that one big move ends up being in the calculation of historical volatility for like a month, right? I specifically use 21 trading days to calculate my historical volatility because that represents a month worth of trading. So the implied volatility or the historical volatility is basically going to be wrong for a month. It's what we call at Market Taker a volatility mesa. And so the analysis of the volatility ended up using one bad data point because of that volatility mesa. And I think a lot of people would have sort of miscalculated it, misestimated it because of that volatility, Mesa. So we always want to be conscious of those. I wish we could screen share on this audio podcast so that I could show an example. But, I call it a Mesa because, it's like, you've got sort of this line, this landscape, and then like there's one big cliff that goes up and it stays up for, a month. And then as soon as that one big move drops out, then we get a cliff on the other side. And then historical volatility is normally priced again. So those are things that you really want to be aware of and really be careful of. I think that I first introduced that concept of mesas in my book, Trading Option Greeks. So those of you who have a copy of that, you can read up on that in some of the volatility chapters.
All right, let's get out some of our own questions of the week here. Last week, let's pay off that one first. Last week, we asked you, in this period of uncertainty in the market, which options trades are you utilizing in your portfolio? Don't see your choice, then, of course, send in your alternatives. And nearly half, 50% of you chose short puts or put spreads right now. So looking probably to get long the market. We're thinking broad market here, so we're looking more probably S&P and Qs and things like that. But that approach can be utilized in a lot of different names right now to use a short put or put spread to get long. Nearly half of you, 49%, are utilizing that approach right now. Then number two, 22.4% of you are saying you're getting long calls and call spreads, so you're still looking for that upside move there. Then third, we had ratio spreads and butterfly, 16.3%. Bringing up the rear, I thought it would get more love. Collars and risk reversals. No love for collars here, Dan. That kind of surprises me. And this week's question, we're saying the markets were rocked by Powell last week and are still down to start the week. I guess we should just blame options expiration for all this sell-off we've had over the last 5 days. Does the second leg of the inflation sell-off still have legs, or will the bulls return with a vengeance? Quite simply, where will the S close at the end of Q3? We gave them 4 ranges, Dan. So higher, so north of 43. In the range they were when we posted it, so somewhere between 4,000 and 42.99. Or lower, the range we are currently, 3,700 to 39.99. Or much lower, below 3,700. Dan, what is your vote for where the S&P will be at the end of September? And more importantly, what do you think our audience is voting for?
Boy, a whole month from now, boy, oh boy, man, this is a good question of the week, my friend. I like that. Usually I get to cheat and look at the answers, but it all says 0 now. Geez, man. I guess that must be because you just posted it. So, by the way, even when I have the numbers there, I always still, kind of guess. But boy, oh boy. So let's see. Right now we're at 300 to 3,900. Man, I am going to say that a month from now, I'm going to say a little lower is what I'm going to say. But I say that with a low confidence interval. And you mind if I talk a little bit about the last question of the week here that you were mentioning?
I explicitly refuse. Do not. Have at it, sir.
What if I say please?
All right, fine. Only if you send me pictures of that dog.
All right. Got to go to my Instagram. It's interesting that, folks, 49% of people say short puts or put spreads, because I'll tell you what, man. I look at these polls that you put out here. Mark puts all these together. I look at all these polls that you put out, and I know, I can tell from the results of these polls that our audience is pretty smart, is really smart. I dare almost call them, not almost, I dare proudly call them the smart retail money. And the fact that 49% of them are selling puts and put spreads is really interesting. In fact, I might even want to change my vote from lower to maybe around here. I'm a little nervous about going higher, but that's pretty telling that the smart retail money, the folks that listen to our show, are taking positive deltas and seem to not have a whole bunch of fear. And I know, like maybe a month or two ago, you asked a question like this, and there was a lot of folks who were hedging. and who were long puts are out of the market. And so this seems to be a reversal in that answer. So, boy, I don't know. Yeah, you know what? Yeah, I have to rescind my first answer. I'm going to say around here, because of what our audience said about short puts and put spreads, I just simply can't say lower. I'm going with you. I'm going with our audience in that regard, from them putting their money where their mouth is for how I answer this question.
Well, our audience is going lower, Dan. They're choosing the 3,700 to 3,999 tranche there, 37.3%. It's a nice evenly split number, though. It kind of just shows how polarizing this market can be. Around here, 4,000 to 4,299 getting 23.7%, also getting 23.7%. Higher, north of 4,300. Only 15.3% of you saying below 3,700. So kind of back where we got in the nadir of the sell-off of this summer. Speaking of polls, right now, 83.3% of our audience in our flash poll, Dan, do not agree with the journal's claim that the options market was a primary driver for the market rally. Only 16.7% agreed. Does that surprise you, sir?
Boom, take that, Eric.
In your face. No, we don't want to slam the article. They draw some parallels and some distinctions that perhaps, I don't know, are there. No one choosing what is gamma so far, Dan, so that's a good thing. We'll look at the silver lining as we get out of here on this question. This is the perfect one for you, Mr. D. This comes from Niels Tim, or maybe Neil S. Tim. Either way, he says, is there one key understanding that we should take away from our study of... he writes it in a strange way. Let me try that again. Is there one key understanding that we should take away from our study of the Greeks? And I think you should probably add, and if there is, what is it, Dan? We'll add a little bit to Neil's question.
The one big thing is use them, right? They're very important. I mean, one of the ways that I like to describe an option in the context of the Greeks is it's almost like trading an option is almost like trading, let's just call it an ETF, right? I would say a basket, but let's say trading an option is like trading an ETF. Like you're taking a position in several things all at once. You're taking a directional position, long or short or neutral. In delta, you're taking a position on time. Time versus gamma is really the best way to think about it. Will I make money by time passing because the stock doesn't move too much to hurt me? Or do I need the stock to move a lot because I have positive gamma and negative theta? I'm taking that position. I'm taking a position in implied volatility. These days, I can justify that we're actually taking a position in interest rates if we're trading longer term options. I think that would be a really great takeaway, is that you are making or losing money on the Greeks, whether you know it or like it or want it. So think about them. Like, think about your position structuring in such a way that you hope to make money from all the Greeks and maximize your exposure so that you're putting on the most logical position for your thesis based on direction and time versus gamma and implied volatility and maybe even interest rates.
All right. That music means we've come to the end of this journey. What a far-reaching journey we had today, listeners. Many different conclusions to draw from today's episode. First off, you guys think the market will be lower a month or so from now out there? You're using short puts and put spreads to get longer at those lower levels. So that certainly tracks. And then also that expiration can be a highly volatile period for the market and for individual stocks because of all the accelerating impacts of that exponential explosion of gamma around those events. Extrapolating that to then say that is somehow causing these other trends in the market, that's a separate thing. And the notion that the increased overall options volume also drove that, I think that's a bit of a stretch as well. Now, we should also put the caveat over all of this that the period we are analyzing and what they were talking about in the article, what they are attributing all these effects to, is the summertime, which is also the thinnest period in the market. So it doesn't take much to really impact that. A fact that Jem makes at the end of the article when he says in the summertime, it could take less than 50 billion worth of flows to move the market intraday. So they do address that in the market. But this is all a very strange period. A lot of things could have outsized impacts in a thin market that otherwise they would not. So reading too much into that, let alone the notion that these expiration periods are the line of demarcation where this trend begins and ends, I think that's a bit of a bridge too far. Mr. Dan, any final thoughts here, any takeaways from today's episode, I should say? And also, if folks want to reach out to you with questions or comments, where should they go? What should they do?
Well, friends, I guess as far as more comments go, I'm going to have to think of more dog tales for next week. But if you want to follow me and you don't want to see my cute dogs on Instagram, then make your way on over to markettaker.com, 2 T's in a row. And we're definitely happy to chat with you. Feel free to message us. Feel free to join free, get some of our complimentary classes. As well as for right now, our chat room is free, and we're sharing trade ideas in there all day long. It's a really great resource, and we'd love to hear from you.
Check them out, markettaker.com. I have a feeling we're going to be hearing more about this episode, Dan, in the coming weeks. So if you have questions or comments, insights you want to share, your own deductions about this, you agree, disagree with the assertions in the article, or what Dan and I were saying, hit us up, let us know. You know where to find us. At Options, most of the major social media platforms. Questions at theoptionsinsider.com. Also works, of course, for all you pro cats. You can get at us instantly via the chat. That's going to do it for our live today. We have Brian coming up a little bit later on OPR. He will be live to tape. I am working on getting him back on the old huddle. He's still trying to get that fantasy football show going. We'll see if we make that happen, the listeners. Then back again tomorrow for the option block and Twifo Friday volatility views, and for all you cool cats in the secret club, back again for options oddities. Then back again next week on Monday with the option block, all the way through to another Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.